Using pre-tax IRAs and 401k accounts can be an effective way to defer income taxes during your working years. But inheriting these type of accounts can create unique challenges. And if you're not careful, you could end up losing a large chunk of it to the IRS through taxes. The rules have changed. And if you have a large pre-tax retirement account balance, or if you stand to inherit one, you will be forced to take money out of these accounts much sooner than you may have previously anticipated. In this video, we're going to look at why inherited IRAs have become such a significant issue as of late, and I'll discuss 5 strategies you can use to reduce the income taxes associated with these type of accounts. So if you currently have a large inherited IRA, or you stand to inherit one, you don't want to miss those. First, why have inherited IRAs become such a big issue recently? Well, there are 4 primary reasons. Number 1, we are seeing the first generation who had these type of accounts available for most of their working lives pass on. IRAs and 401k plans were introduced in the 1970s. But in the 1980s, the IRS issued a ruling clarifying 401k contribution rules that employers could begin offering salary-reducing contributions to 401k plans. These are your typical pre-tax contributions that most people make. This feature supercharged the use of the 401k tax deferral strategy that most people use today. Number 2, there have been massive market gains over the last 40 years. Here is a chart of the S&P 500 from 1985 until today. In 1985, the value of the S&P 500 was under 200. Today, it's well over 5,000. So just think of all those pre-tax assets in these IRA accounts and the compounding growth they experienced over this period of time. Number 3, shifts from pension plans to defined contribution plans. Typically, pension plans could be passed between spouses, but not typically children. So when parents died, the pension died as well. 401ks and IRAs created accounts that could be passed down to the owner's children. And there's also been a shift away from pensions to 401k plans. If you've ever seen the 1987 film Wall Street, when Bud Fox walks into the war room and learns the deal points of Gordon Gekko's acquisition and subsequent dismantling of the airline his father works for. The airline gates are being bought by so-and-so, the planes are going to be sold, and the overfunded pension liability was going to help Gordon Gekko clear $60 or $70 million. In 1985 dollars. In today's dollars, that's probably billions. So between corporate raiders demolishing them and companies no longer wishing to incur the related costs, pension plans have largely gone away, and 401k plans have filled the void. Number 4, recent tax law changes. Someone who inherited an IRA used to be able to take the required minimum distributions over their lifetime, effectively stretching the lifespan of the inherited IRA. The younger the person was, the lower the percentage of the IRA they would have to take in any given year. But the Secure Act recently changed this. You may have heard the phrase, death of the stretch IRA. Now, if you inherit an IRA from your parents, you will be forced to zero out that IRA within 10 years, as opposed to dragging it out much longer. These 4 things working together have created an unprecedented level of pre-tax assets in 401k plans that are now going to be transferred to their children, who are forced to take distributions from and recognize the related income taxes faster than ever. So what are the steps that can be taken to reduce the tax implications of inherited IRAs? Now, before getting into the steps that can be taken to reduce tax, there is some nuance here about how one inherits accounts and which rules will apply. So to clarify, I'm talking about the type of transaction that I normally see, and that's when adult children inherit a parent's IRA. If your scenario is different from this, then different rules may apply. Also, make sure you consult with your own financial advisor or tax professional before taking any action. So what are the steps you can take? Number 1, start planning early. And I'm not talking about just the people inheriting the IRA. I'm talking to the people who own significant IRAs. If you own a significant IRA that you plan to give to your kids, or if you know your parents have a significant IRA that you will soon inherit, take advantage of the intergenerational planning opportunities. If your parents have a lower tax rate than you, or live in a state with lower or no income taxes, it may make sense for them to take distributions or convert to Roths before their passing. This is especially true if you anticipate being in your highest earning years when you are forced to take the distributions. Number 2, figure out if you need to take RMDs. The general rule of thumb is if your parents were already taking RMDs, then you will need to do so also. So get an understanding of how much income you'll be forced to recognize in addition to zeroing out the account before the end of year 10. Number 3, incorporate these accounts into your financial plan. Inheriting a large amount of money can shore up, if not accelerate, your retirement. Between asset location, asset allocation, and minimizing the income tax impact, to deciding whether or not Inherited IRA will provide enough cushion for you to begin considering your retirement, get an understanding of how this asset will affect your retirement plan. Number 4, coordinate with other income streams to manage the income taxes. Use tax projections to see which years make the most sense to draw these accounts down. This is part of any comprehensive financial plan, but make sure you look at how these distributions may affect your income tax picture. If you're thinking about retirement in a few years, it may make sense to delay taking some of the larger distributions until you stop working. Number 5, use QCDs if you qualify. If you are over 70 and a half, or are going to be within 10 years of inheriting an IRA, you can use qualified charitable distributions to help you reduce the taxable income associated with zeroing out an inherited IRA. Given their size, inherited IRAs are becoming an important planning point for many households. Make sure you understand how they can be used in your planning process and take advantage of strategies that will reduce its impact on your overall financial plan. Being proactive will pay dividends and give you the upper hand to reduce the taxes associated with drawing these balances down once they are inherited. If you plan to give one of these to your children, understand the income tax consequences and look for ways to efficiently reduce the taxes associated with the account while it's in your hands or your child's hands. Intergenerational tax planning can be invaluable in this regard. If you have a large 401k balance and are still working, I did a video that describes your options once you leave your employer. You can find a link to that video here. If you enjoyed this content, please hit like and subscribe. Thanks again for watching, and I'll see you next time.